For those of you that liked the crazy SCHD breakdown I did recently, you're going to love this one. Everyone knows that in 2023, the NASDAQ 100 just completely destroyed the S&P 500. But why? In this video, I'm breaking down for you every single aspect of the NASDAQ 100 you need to know about to understand why did it perform so well in 2023? What are the weightings of all of the stocks in the NASDAQ 100 and how did that impact the results? Some of the unique elements such as which of the stocks in the NASDAQ 100 actually pay dividends and did that impact the results? It definitely took a while to get all of these individual stocks into this one spreadsheet, so make sure to stick around all the way to the end of the video because the last graph I'm going to show you, the last data point we look at, is going to be the most impactful and tells the whole story in just one picture. What's up, you guys? Welcome back to the Average Joe Investor channel. Happy Tuesday. Today we're looking at the NASDAQ 100, specifically the ETF QQQ. When you think about the NASDAQ 100 or QQQ, what do you think of? Well, probably robotics, innovation, AI, and you would be correct. QQQ was launched in 1999, and as they say on their website, one fund, 100 companies, the QQQ provides exposure to companies at the forefront of innovation across a diverse range of sectors, all in one investment. And one of the things they love to talk about is how QQQ outperforms the S&P 500. It's the #1 highest rated, best performing large cap growth fund, the #2 most traded ETF outside of SPY, and has a 5-star Morningstar rating. Also, for full awareness, it has a 0.2% total expense ratio on an annual basis and $229 billion in assets under management. Here's a look at just the top 10 holdings, and believe me, we're going to go much deeper than this. Apple, Microsoft, Amazon, Broadcom, Meta or Facebook, Nvidia, Tesla, Alphabet, Class A and Class C, which is Google, and Costco. And when it comes to sector allocation, technology is the definitely #1. Technology at 57.1%, consumer discretionary at 18.7%, healthcare at 7%, telecommunications at 5%, industrials at just under 5%, and then consumer staples at 4%. Utilities, energy, real estate, and basic materials really are not represented at all in this ETF. Enough about those general details though, let's dive into the spreadsheet. Which, by the way, this spreadsheet, as well as all of the other spreadsheets I create on the channel, are available if you're a member of the Average Joe Investor Patreon community. In addition to these spreadsheets and the monthly dividend stock spreadsheet that comes out every month, you get access to my portfolio, the changes I make to my own investments, as well as the best benefit, in my opinion, which is access to the Average Joe Investor Discord community, where you of course get access to me, as well as all the other like-minded Average Joe investors out there. If you want to learn more about joining the community, check out the link down in the description below. All right, here's a look at the overall graph. We're gonna come back to this in just a second here. As you can see along the bottom here, I have all of the different investments here, all of the different top 50. I looked at the top 50 stocks based on weighting in the NASDAQ 100 or QQQ. Also, for your awareness, when it comes to the actual graph I use and the income, I assumed for all of these investments, an investment of $1,000 at the beginning of the year, reinvested all dividends if they paid dividends, and did not add any additional contributions. And here's a look at all of the stocks I utilized here. You'll notice that the top 50 have a cumulative weighting, a weighting, and a total return. And the bottom 50 I didn't actually look at here, but the top 50 I did look at represented 84% of all of the assets in the ETF. So I feel like a fair representation of how the ETF actually performed. One of the first things we should talk about is just how top heavy this ETF is. QQQ, again, only 100 holdings, but the top 2 holdings, just the top 2 out of 100, make up, as you can see right here, 17.75% of the weighting, Apple and Microsoft. So hopefully they did well. If you look at the top 5, 1, 2, 3, 4, 5, that makes up 30% of the assets. The top 10 make up 45% of the assets. The top 25 make up 67% of the assets. And again, the top 50 here, just the top 50 make up 84% of the assets. So very much a top heavy ETF. We're gonna do something similar with the S&P 500, but what I wanted to call out here with these top 50 assets is look at the breakdown here in the total results. This is total returns based on an initial investment of $1,000. The first thing I want to call out here is right here, look at 1, 2, 3, 4. There were only 4 out of these top 50 stocks that lost money in 2023. And this is represented on the graph right here. This white line is $1,000. And everything except for 4 stocks finished above that. Some of them massively overperformed. And one thing I did in the SCHD breakdown that I did here as well is I definitely changed the actual thickness of the line based on the weighting in the ETF. So green and red are the thickest ones here. They're a little bit hard to see. Green and red represent Apple and Microsoft. They definitely performed very well. In fact, if we look at the breakdown here, we can see that Apple had a total return of 54.79%, and Microsoft had a return of 58.35%. Then you also had a few other ones that massively outperformed, and they also happen to have a rather heavy weighting in the ETF. We've got in orange right here, NVIDIA. We've also got in yellow, Tesla, and in blue, we have Meta. All three of those performed well. The third highest weighting had a 77% total return. Broadcom, the fourth highest weighting, had 106% return. Meta, 183%, and NVIDIA, 246% based on the original $1,000. And then fifth here, Tesla, 129%. So the top, what is it, right here, the top 7 holdings, 38% of the assets, every single one of them had a total return exceeding 54%. That is insane. And you can make the case not something potentially that you could replicate on a consistent basis. Essentially, the big breakdown here is the largest weightings, delineated by the thickest weightings of these lines here, all did extremely well, which is why QQQ did extremely well. Here's a breakdown of that top heavy weighting. You can see the top weightings here, significant right here, and then just a massive drop off after the top, I don't know, top 10, maybe top 15. And here's that graph I wanted to show you guys that really tells the whole picture, shows everything that happened in the QQQ for 2023. On the left, you have weighting. This is the chart right here for weighting, and that's the green right here. That's the total weighting for each of these stocks for the top 50. And then on the right here, you have total return, and that's represented by the pink dots right here. So you'll notice here that all of these top weightings performed significantly well. Right here, these 1, 2, 3, 4, 5, 6. Insane results for these top 6. Now, it's true that the S&P 500 also had a similar breakdown in that the top S&P 500 stocks are very similar to the top ones in the NASDAQ. They just don't have as significant of a weighting, which is why the S&P 500 did not outperform and was nowhere near the QQQ for 2023. One other interesting thing to point out here, when it comes to the top 50 stocks, how many of them actually pay dividends? Now, most of them don't pay a lot of them, but let's take a look here. So we're largest to smallest on the dividend income here. Of the top 50 that we looked at, there were a total of 22 of them that do not pay any dividends at all. And those happen to be some of the top performing stocks in the ETF, which means if you take the other, 38 or 28 stocks, they did pay dividends. And the top ones here are ones that are also representative in SCHD and in the S&P 500. Stocks like Gilead, which had the highest, then Broadcom at $35 and then $34, then Amgen at $33, Cisco, Texas Instruments, Qualcomm, Intel, Pepsi, etc. A few things to keep in mind as we think about takeaways of this breakdown of QQQ. Number one, 2023 is in and of itself an island. Just because it performed extremely well in 2023 does not mean that future results are going to be based on past performance. Now, it's true that in the past 10 to 15 years, QQQ has had significant years of outperformance. But it can also be said, though, that it also has a lot more volatility, which means the good years are going to be better than the S&P 500, and the bad years are going to be worse than the S&P 500. One of the reasons I personally like to utilize QQQ is not necessarily for long-term holdings. To be perfectly transparent, in my own retirement accounts, I use the S&P 500 SPY. I write covered calls. I just like the balance, at least more balance that you get with QQQ. But that does not mean QQQ cannot be utilized for long-term holdings as a way to diversify away from the S&P 500. It also offers more lucrative option premium. To be completely clear here, I do not recommend necessarily throwing all of your money into QQQ. It is a great way to diversify away from IWM or the Russell 2000 and the S&P 500 because of its extreme focus on technology. And a strong argument can be made that when it comes to technology, that's going to have a much higher significant weighting in the future of the US economy. Hopefully you found some value in this video, guys. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many comments as possible on the day I post a new video. That's all I got for you guys. Have a great rest of your day. Thanks for watching.